$4 trillion. That's the market cap of the company we're breaking down today. The most valuable chipmaker on Earth, the engine behind the AI revolution, and a stock that has turned more retail investors into millionaires than arguably any other name in the last 3 years.
And yet it's still 16% below its all-time high. So the question isn't whether Nvidia is a great company. That's settled. The question is whether it's a great stock at this price.
Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas. Today it's Nvidia, ticker NVDA, the company that went from making gaming graphics cards to powering the entire artificial intelligence infrastructure stack. Lana Chen has the numbers.
Let's dig in.
Nvidia is headquartered in Santa Clara, California, founded way back in 1993. But the company you're looking at today bears almost no resemblance to what it was even 5 years ago. This is now, first and foremost, an AI infrastructure company.
The revenue breakdown tells the story. Data center operations represent nearly 90% of total sales. Gaming, which used to be the core business, is now about 7%. Professional visualization and automotive round out the rest at under 3% combined. Total fiscal year 2026 revenue, and remember, Nvidia's fiscal year ends in January, came in at $215.9 billion.
$216 billion. To put that in perspective, that's more than the GDP of most countries. And the competitive landscape, AMD is the closest public challenger, Broadcom plays in adjacent markets, Intel is trying to catch up, and then you've got the hyperscalers like Microsoft and Amazon building their own custom chips. But Nvidia's moat is the CUDA ecosystem.
That's the critical point. It's not just the hardware. CUDA is the software platform that every AI developer builds on. Nvidia holds 85 to 90% GPU market share in data centers, and their networking infrastructure grew 267% year over year. They're becoming the full-stack AI platform, not just a chip company.
And the timing is extraordinary. At GTC 2026 in March, Jensen Huang announced the company has visibility into $1 trillion in purchase orders for Blackwell and Vera Rubin chips through 2027. That's not a forecast, that's orders on the books. Speaking of Jensen Huang, he co-founded Nvidia in 1993 from a Denny's restaurant in San Jose. He was 30 years old. He's been CEO for 33 years now, making him one of the longest tenured tech CEOs in history.
His background is electrical engineering. Oregon State for undergrad, Stanford for his master's. Before Nvidia, he worked at LSI Logic and AMD. But what defines Huang is his ability to see around corners. He bet on CUDA when nobody was asking for it, bet on AI training when the market was tiny, and bet on data center GPUs when gaming was still the bread and butter.
He was appointed to the President's Council of Advisors on Science and Technology in January 2026. Forbes puts his net worth at $164 billion, seventh wealthiest person on the planet. The leather jacket is iconic at this point.
Let's get into it. The stock is trading at $177.64 with a market cap of $4.31 trillion. The 52-week range runs from 86.62 to 212.19. So the stock has more than doubled from its lows, but is still about 16% off the highs.
What do the valuation multiples look like?
The trailing PE is 36.2, which sounds expensive until you see the forward PE at 21.5. That compression tells you the market expects significant earnings growth. Price to sales is about 20 times, EV to revenue is 19 times. These are premium multiples, but for a company growing revenue 65% year over year, they're not unreasonable by growth stock standards.
How's the revenue trajectory?
Exceptional. Trailing 12-month revenue was $215.9 billion, up 65.5% year over year. The quarterly progression is striking. Q2 was $46.7 billion, Q3 was $57 billion, Q4 was $68.1 billion. That's consistent sequential acceleration, which is rare at this scale.
Profitability?
This is where Nvidia separates from almost every other company in the S&P 500. Gross margin is 75.1%. Operating margin is 60.4%. Those are software company margins on a hardware business. EPS came in at $4.90. Trailing,
And the cash generation?
free cash flow was $96.7 billion. Let that sink in. Nearly $100 billion in free cash flow in a single year. Operating cash flow was $102.7 billion. Capital expenditure was relatively modest at $5.4 billion, which tells you the margin leverage in this business model.
Balance sheet?
Fortress, $62.6 billion in cash, $8.5 billion in total debt. Current ratio of 3.91. This company could fund a medium-sized country's annual budget from its balance sheet alone. Overall, Nvidia's financial health is strong. The revenue growth, margins, and cash generation are among the best in the history of public markets. The only debate is whether the valuation fully reflects the growth ahead or leaves room for upside.
What's the analyst picture?
It's about as bullish as it gets. 43 analysts cover the stock, 41 rated a buy, 1 hold, 1 sell. The average price target is $273.57, which implies 54% upside from current levels. The range goes from $220 to $380.
Who's the most bullish?
Cantor Fitzgerald has the street high target at $300. Goldman Sachs is at $250, Morgan Stanley at $260, Bank of America at $275. Last earnings on February 25th showed $44.1 billion in revenue, a beat on both top and bottom line. EPS of 96 cents also beat. Guidance calls for Q2 revenue of $45 billion, but H20 export controls create an $8 billion annualized headwind from China.
So even with China, the street overwhelmingly says buy.
Overwhelmingly.
The bull case starts with the obvious: Blackwell and Vera Rubin. The CFO cited over $500 billion in visibility for these next-generation chips through the end of 2026. Hyperscalers are locked into multi-year procurement cycles. This isn't speculative demand. It's contracted.
That kind of visibility at that scale is almost unprecedented in semiconductors.
Number 2, China market re-entry. The H200 chip approval could unlock $8 billion or more in revenue that's currently blocked by export controls. Any easing of restrictions is a major catalyst. Number 3, the inference transition. As AI moves from training to inference workloads in 2027, that creates an entirely new GPU refresh cycle and software licensing opportunity. Training built the install base. Inference monetizes it. And number 4, networking. Nvidia's networking infrastructure grew 267% year over year. They're not just selling GPUs anymore. They're selling the entire AI data center stack.
Now the bear case. First, geopolitics. The China export controls already cost a $4.5 billion inventory charge and are creating an $8 billion annual revenue gap. The regulatory environment is unpredictable, and any escalation could further restrict Nvidia's addressable market.
That's real money even for Nvidia.
Second, competition is real and intensifying. AMD grew data center revenue 34% last year. More importantly, hyperscalers are building custom ASICs, Google's TPUs, Amazon's Trainium, Microsoft's Maya. These aren't replacing Nvidia today, but they're reducing dependency over time.
The CUDA moat may be deep, but it's not infinite.
Third, supply constraints. High bandwidth memory is in shortage globally, and Nvidia's production is directly constrained by HBM availability. If they can't get the memory, they can't ship the chips. Fourth, valuation. At 36 times trailing earnings and 21 times forward, Nvidia is priced for continued exceptional growth. Any deceleration, even from 65% growth to 40%, could trigger a meaningful multiple compression.
Let's stack Nvidia against the field. We looked at AMD, Broadcom, and Intel.
AMD is the closest competitor with $34.6 billion in revenue and 34% growth. But their data center GPU share is still only 7 to 10% versus Nvidia's 85 to 90. They're growing fast, but from a much smaller base. PS around 12 times.
Broadcom is the interesting adjacent play. AI chip revenue exceeded $60 billion in fiscal 2026, up 200% year over year. But they're a networking and connectivity enabler, not a direct GPU competitor. PS around 15 times.
And Intel is the cautionary tale, still marginal in AI data center, struggling with their CPU business and foundry challenges. Trading at about 2.5 times sales, a deep value play if the turnaround happens, but that's a big if.
What are options traders telling us?
Put-call ratio of 0.72, bullish bias. Implied volatility at the 55th percentile, so moderate. Massive call open interest at the 200 and 250 strikes. Traders are positioning for a return toward the all-time high. Put clustering at 170 marks the key support level. The options market is saying the downside is limited and the upside is substantial.
Insider activity?
2 buys and 8 sells recently, though most selling appears to be stock award conversions rather than discretionary sales. Given that Jensen Huang's net worth is over $160 billion, almost entirely in Nvidia stock, some periodic selling is expected portfolio management, not a bearish signal.
What should investors be watching?
3 things. First, China policy. Any movement on H20 or H200 export approvals changes the revenue picture by billions. Second, gross margin trajectory. Guidance of 71 to 72% for next quarter is a slight decline from 75. Watch whether that's a temporary mix shift or the start of a trend. Third, hyperscaler CapEx commitments. Nvidia's revenue is a derivative of how much Microsoft, Google, Amazon, and Meta spend on AI infrastructure. Any pullback in that spending hits Nvidia first.
Lana, bottom line on Nvidia.
Nvidia is the most dominant technology company of this era. $216 billion in revenue, 75% gross margins, $97 billion in free cash flow, and near total control of the AI GPU market. 41 of 43 analysts say buy, with a 274 target implying 54% upside. The risks are real. China export controls emerging competition and premium valuation, but the growth trajectory and cash generation are historically exceptional. The key metric to watch is data center revenue acceleration. As long as that holds, the thesis holds.
We'll close with this one from Jensen Huang himself at GTC 2026. He said, "The next industrial revolution has begun. Companies and countries are partnering with Nvidia to shift the trillion-dollar traditional data centers to accelerated computing."
$1 trillion shift. That's not a product pitch, that's an industry transformation thesis. And so far, the numbers are backing it up.
That's going to do it for episode 51 of Charged Alpha, Nvidia, ticker NVDA. If you found this deep dive valuable, share it with someone investing in the AI space. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.